Hey there, Michael Manotsky here, creator of the Deal or No Deal Creative Finance Calculator. So today we're going to be going over how to use the free version to underwrite a straight sub-2 deal. So a subject-to deal is when you're taking over the existing mortgage from a seller. You're basically taking over the responsibility of the payments. You're taking over the loan balance, and you're not assuming that loan, but you're taking over the responsibility of that loan payment and the monthly payments associated with it. So we're going to look at how to underwrite it today very specifically. So every time you start on the calculator, the first thing that's going to happen is this disclaimer is going to pop up. So feel free to read it and then just close it out. We'll get into this stuff in another video, but let's talk about underwriting the sub-2 deal. So in another video, we discussed how to fill out this section, the basic property information, how to conduct your after repair value analysis. Today, we're just going to focus on the underwriting a sub-2 deal. So for this to be a straight sub-2 deal, it means your purchase price minus the loan you're taking over and the money you're paying to the seller up front has to equal zero. There should be no equity left over. That's a straight sub-2 deal. If there was money left over, you'd either have to pay the remainder of that out to the seller, or that equity would be seller financed, and that'd be a hybrid deal because you have both a subject-to deal and a seller finance deal at the same time. So let's talk about underwriting this deal. So the first thing you're going to want to do with a straight sub-2 deal is understand the loan terms. So first and foremost, let's say you want to understand what the seller purchased their property for initially. What is the loan that they originally took out? And that's what you fill out here. So what is the original loan amount? In this instance, it's $200,000. The interest rate that they got was 3%. It was a 30-year amortization term. Most commonly, it's 30 or 15 years, but usually it's 30 years. And all this information should be on the mortgage statement. And then when did they make their original first payment? So in this instance, it's June 1st, 2021. All these values are utilized to calculate what the monthly payment is on this loan balance. At these terms, the principal and interest payment is $843.21. That value goes right into here under the cash flow analysis section under your expenses. The first expense being the principal and interest on the sub-2 loan. Don't worry, the taxes and insurance are down here. We'll do that separately. So just to confirm, when you're buying the property, you're not taking over the loan amount that they originally took out. You're taking over the remainder of that loan amount. So in this instance, we're taking over $189,321.66. There's an easy way to verify if this is accurate. If this is the value, if these are the values that were provided for your original loan, just use your amortization schedule or the sub-2 payment schedule here to look at when you're taking over the loan on this date on 12/1/2023, what is the amount that you're taking over? $189,321.66. These should be the exact, this should make sense because that all these payments, when they took out the original $200,000, every payment they made, they've been making principal and interest payments, interest and principal payments that have been reducing, the principal has been reducing their existing balance. And this is already calculated for the whole 30-year term. This is how the banks do it, and this is what you're keeping track of here as well. So with that, you should know exactly the amount of loan you should be taking over. There could be a few hiccups, right? If there's a refinance, maybe the loan just means you're basically restarting a new loan at those terms at that time, at that amount. Or maybe there's arrears, they didn't make payments, something. But for the most part, this should be pretty straightforward in that regards. So let's move on from there. You're taking over the $189,322 loan from the seller, and your first payment date, well, you'll be responsible for that loan, is 12/1/2023. So now let's move towards actually underwriting this. We have the loan amount, we have the amount that you're taking over, which gets moved over to this remaining sub-2 loan. These are the same values. So your purchase price is $220,000. That's what you agreed to with the seller. Assuming a 10% down payment, you could change this. Let's say you have 5% or you have 25%, whatever. You can change this amount, but we're going to go back to the 10%. We're going to say this is supposed to be a straight sub-2 loan. So this purchase price minus the down payment, the cash to the seller, minus the remaining sub-2 loan should equal zero. But there's still $8,678 remaining. So that means either you need to pay the seller an additional that means you need to pay the seller the additional $8,678, or you need to seller finance that. Since we're doing a straight sub-2 transaction here, let's just add this $8,678 to this down payment. So we're going to disregard this percentage now. We're going to do the $22,000. So we're going to say $8,678 plus $22,000. That should get us now, there should be no equity remaining, no seller finance loan, no equity left over to seller finance. And you're paying them $30,678. So as we continue to run through this, you have your purchase price, the cash to the seller, the down payment, the sub-2 loan you're taking over, and there's no loan amount left over, which is good. It's exactly what you want. You have the monthly payment of the subject to loan that you're taking over, and that is added here. So next is the rental income. So you have a little rental comp section that we have here. There's another video on getting rental comps, but you have the rental comp section here. And let's just say, for instance, this property rents for $2,650 a month as a long-term rental. So now let's continue on with underwriting the expenses to see if this property cash flows. So you have an expenses section, other expenses and reserves, and we'll go through all of that right now. So in this instance, we're saying you're taking over the $843 principal and interest payment, which is calculated up here. There's no seller finance payment. There's no additional property mortgage insurance or principal and interest loan you have to worry about. The property taxes, let's say it's $3,000 a year. You just put that in here and that'll calculate your $250 a month, just 12 divided by that. Your insurance, let's say it's $1,200 for the year, so $100 a month. There's zero HOA. You're not responsible for any utilities. Since a long-term rental, your tenant's going to cover it all. So you have your water, heat, garbage, electricity, all that's covered by the tenant, but you do pay $50 a month for landscaping. So this is showing you that your monthly expenses are $1,243 between your loan, taxes and insurance, and the landscaping cost. And there's some other expense for you to worry about now. So property management, this is a function of this percentage right here, which is 10%. That's the common going rate for property management companies. It's that value times this $2,650 a month of rental income is what is calculated right here for the property management. You could change that to 8%. You could change that to 12%, whatever is the going rate for your area. That's the value you'll put there. Even if you're going to self-manage, you could put 0%, although I don't advise that because at some point you're not going to want to manage this property yourself. You want to make sure that you have the property management fee accounted for here. This private money lender entry cost financing is if you have a private money lender that's going to cover this $48,000 of entry costs, that this will basically tell you what is the interest-only payment, monthly interest-only payment, annual interest-only payment on that $48,000 to pay back your private money lender. We're not going to go into that right now, but just for example, let's say it's a 10%, then that is the amount that you will need to pay each month to cover your private money lender for your entry costs. But we're going to zero that one out. And then reserves, you definitely want to make sure you have you're accounting for reserves, starting with a vacancy, which is just when your property is sitting vacant. 8% basically just translates to 1 month of the year the property is sitting vacant. So you want to account for your vacancy, and you want to account for maintenance and capital expenditures. Maintenance are your routine maintenance. You send a plumber or electrician out. Capital expenditures is when you have bigger purchases that you have to do over time as your property degrades. So, for example, your roof replacement, maybe appliances, things like that you're saving for. 8 to 10 are the standard amounts. So at this point, you have your loan terms, you have your rental income, you have your expenses, including your loan and your reserves. Next, we're going to go into the entry costs. So what comprise the entry costs are your down payment to the seller. This value is pulled from this down payment right up here. It's just the same value there. If there's an agent involved, if you're paying them a commission, so usually, let's say it's a 5% total commission, but you're underrepresented, you're only paying the seller's agent yourself, and you're paying for that, then here it says 2.5% is what you're paying the agent. Arrears or liens, so if there's any additional loans or back payments on the loan that you have to pay off, you'd put that value here. Any rehab or renovation costs here, we just put $1,000. Please overwrite that with what makes sense for you. In this instance, that's if there's just simple cleanup or minor touch-ups you need to do. $1,000 is not a lot of money, so just basic cleaning on the property. Any closing costs, which are calculated by this 3% times the purchase price, is this closing cost amount if you are the one responsible for it. Adjust that to make sense, whether a percentage works well for you for your underwriting or a flat amount. Any marketing or exit costs if you're going to post it anywhere or need to pay for any of these services. An assignment fee if you're looking to wholesale this deal. This gives you a good idea of what your assignment fee could be, but let's see what the deal looks like before you do that. And then any carrying costs, which are basically, this is your monthly carrying costs, so your monthly expenses you have to worry about, times the number of months you want to have these carrying costs account for. I like a standard 3 months for any property that we're acquiring. So it's just this carrying cost is this monthly carrying expenses right here, which is this value, times the number of months you want to save have saved. So these carrying costs are a combination of all of these, and these entry costs are the totality of all of these expenses you need to basically get into the deal. So if you want to estimate how much it'll cost you to get into the deal, it's not just the down payment to the seller. You have the agent commissions, a little bit of money for rehab, closing costs, marketing costs, and then your carrying costs. So that's what comprises your $48,008 here. So then next is your deal or no deal analysis section. So basically what you're calculating here for this long-term rental is the net cash flow, which is just your income minus your expenses. So your rental income minus your expenses. Let's break that down even further, right? It's your income minus your expenses, minus any property management expenses, minus reserves, maintenance, CapEx, and vacancy that's here. That's what this net cash flow amount is here. And then if you had any private money lender costs, it would go in here. So for example, if we put the 10% private money lender costs here, that'll auto-populate this section, and that'll automatically change your net cash flow. Let's disregard that for the time being. And then next are your goal sections. So the goal in this instance is your net cash flow. Your goal is $100 a month of cash flow on this property. You're generating $665. This tells you that that's a deal. Based on your goal of $100, which you can change to $1,000, which will tell you it's not a deal, or whatever your amount that you're looking for, put your goal here so it's easier for you to determine if that's a deal or not. These right here are just your totals of your income, expenses, property management, and reserves. These are your annual totals of those amounts. And then the other factors that you're looking for as a long-term rental is not just your cash flow. There's also the cash flow without reserves. So if you were not saving for property management expenses, or you were not saving for these reserves here. Actually, so if you were not saving for maintenance, CapEx, and vacancy, that's what this value is telling you. So basically what I like to think of is this net cash flow is kind of my worst case scenario as long as my above income and expenses are correct. Worst case scenario, I'm making $665 a month on this property from income minus expenses, and I'm accounting for property management, all the reserves for maintenance, CapEx, and vacancy. But if you've ever owned property, you know that it's not always the worst case scenario. You're not always paying for maintenance, or there's not always vacancy. So that's what this value tells you. It's kind of your best case scenario. If everything goes perfectly, you have no vacancies, no maintenance, no CapEx, then your best case scenario is $1,142. So it's really good to understand that full spectrum between your worst and best case scenario, as long as your property is performing. And then next, the most important metric for underwriting long-term rentals is your cash on cash return. All that simply is your annual net cash flow. So how much cash flow you make per year divided by your entry costs here. And most people are looking for around 10 to 12% cash on cash return. It really depends on the buyer, the market they're working in, and what your end goal is. But if your goal here is 12%, this one is a deal, because this one, the cash on cash return, is 16.62% cash on cash return. There's other metrics here as well. For example, your instant equity, which is just your purchase price and then the after repair value is just what is the difference between the value of the property minus the value of the property or the purchase price of your property. And then other metrics people like to consider are your entry fee divided by your purchase price. So how much is it costing you as a ratio to the purchase price to get into the deal? Same with how much is it costing you as a ratio of your entry fee divided by your after repair value to get into the deal. I'm not so stuck on entry fee to purchase price or entry fee to ARV, but that's something some people do consider. I'm much more focused on my net cash flow, how much am I making each month, and my cash on cash return. How hard is my money working for me? That's really what I'm looking at. Unless there's, equity is also great. So how much are you walking into a deal up front on equity? So that's really how you underwrite for a long-term rental. If it's a straight subject to deal, the one more thing we could do is see what would your assignment fee. Let's say you're a wholesaler and you want to wholesale this deal. You don't want to actually buy and hold it yourself. But you can calculate pretty quickly what is the cash on cash return for the cash. Well, I guess really the cash on cash return for the end buyer that you're looking for. Let's say your end buyer says they want at least 10% cash on cash return. Let's see what your assignment fee could be to get that cash on cash return goal for your end buyer. So right here, you'll just change your assignment fee. That's why I say start with 0 and then adjust. So let's say you set it at $5,000. This is telling you for $5,000 assignment fee, your cash on cash return is now dipped to 15%. Still looks like there's wiggle room for you too. If your end buyer is looking for a 12% cash on cash return, that means there's still wiggle room. You can increase your assignment fee. So let's say it's 15,000 now. So your cash cash return is still 12.66%. Basically telling you this deal, if it was at these terms, and all this is true and your buyer's good with it, and they're getting their 12% cash cash return, you can basically get around $15,000 assignment fee on a deal like this. So this can help you both underwrite you as the buy and hold investor, or whether you're the one paying that $15,000 assignment fee to someone, or you're the wholesaler and trying to figure out what assignment fee could I charge to get my end buyer their desired goal, and then like what's the way I can maximize my assignment fee? What amount is the maximum amount I could charge if this is the goal I'm trying to produce for my end buyers? Okay, well, thank you. If you need anything, please feel free to connect with me. Definitely check me out on Instagram and connect with me on there. That's how I connect with most people. So feel free to check me out. Thank you.